Silver surging, plus 4.5%. The jobs headline didn't stop it. February 12th, 2026. Silver did something it wasn't supposed to do. Strong jobs data dropped, the kind that historically crushes precious metals. The dollar should have strengthened, rates should have climbed, and silver should have fallen, but it didn't. Instead, it surged 4.5% in a single session, breaking through the mid-80s while the market celebrated good news. This wasn't a technical glitch. This wasn't retail enthusiasm. This was the market, quietly, systematically, repricing something the headlines refuse to acknowledge. And when assets ignore their traditional signals, when correlations that held for decades suddenly break, the break itself becomes the message. What is silver seeing that the jobs report couldn't reveal? Welcome to the Comics Chronicles, where we don't chase headlines. We decode what happens when headlines stop mattering. Now, before we go deeper into what February 12th actually revealed, do me a favor, would you? If you've been around long enough to remember when markets actually made sense, when a strong jobs number meant one thing and one thing only, hit that subscribe button. Not because I'm asking for a favor, but because what we're about to unpack requires the kind of attention, the kind of patience that only comes from experience. And while you're at it, drop a comment and tell me, where in the world are you watching this from? Because what's happening in silver right now isn't just an American story or a London story. It's a signal that crosses borders. Now, let's get into what really happened. February 12th, 2026 opened like any other trading day. Analysts prepared for the monthly employment report. Traders positioned their bets, and the consensus was clear. If the jobs data came in strong, precious metals would face pressure. That was the playbook, the pattern that had held for years. Strong employment equals stronger dollar, higher rate expectations, and metals getting sold. Simple economics, predictable outcomes. But markets have a way of teaching expensive lessons to those who rely too heavily on old patterns. At 8:30 a.m. Eastern, the Bureau of Labor Statistics released the numbers. Payrolls exceeded expectations. Unemployment held steady in the low 4% range. And the headline writers got their story. Robust jobs, growth signals economic strength, the articles proclaimed. Equity markets responded as expected. The Dow pushed toward historic milestones, and optimism filled the screens. This was supposed to be bad news for silver. This was supposed to trigger the familiar sequence: dollar strength, rate firmness, metal weakness. But silver didn't read the script. Instead of retreating, it surged. Not a modest tick higher, not a technical bounce, but a violent 4.5% rally that pushed prices back into the mid-80s per ounce. Gold moved higher too. Platinum showed strength, but silver was the one screaming. And that scream was information. Because when an asset ignores fundamental headwinds that should crush it, the market is communicating something that headline data cannot capture. Professional traders understand this principle immediately. Retail investors often miss it entirely. The question wasn't whether silver went up. The question was why it went up, when every textbook reason said it shouldn't. Three possibilities emerge when markets behave this way. First possibility, hidden physical dynamics. Perhaps inventory stress that public data doesn't reveal, demand pressures building beneath the surface, supply constraints that haven't reached mainstream analysis yet. When physical markets tighten, paper prices eventually follow, regardless of what economic indicators suggest. Second possibility, forward policy repricing. Maybe the market stopped caring about today's jobs number because it's already pricing tomorrow's policy response. Strong employment today doesn't eliminate structural pressures, debt servicing requirements, political incentives for monetary accommodation. If traders believe rate cuts are coming regardless of current data, they position accordingly. And metals respond to that belief, not to the headline. Third possibility, structural repositioning. When too many participants lean the wrong way, when consensus builds around one outcome and the opposite happens, forced repositioning creates its own momentum. Shorts scramble to cover, late buyers chase, algorithms pile in, and the move feeds itself. Silver's behavior on February 12th likely contained elements of all three, but the broader message was unmistakable. The market was reading a different manuscript than the one printed in the jobs report. This wasn't about February's payroll numbers. This was about what comes next, Professional analysts began asking uncomfortable questions. If strong data can't suppress silver, what happens when data weakens? If metals rally alongside equities, what does that say about underlying liquidity expectations? If traditional correlations are breaking, what other assumptions need reevaluation? The gold to silver ratio provided additional context. For years, silver had underperformed, the ratio stretching above 100 to 1 at various points, indicating silver's extreme undervaluation relative to gold. But by February 12th, that ratio had compressed toward the low 60s. Silver wasn't sleeping anymore. It was awake. And when silver wakes up, it doesn't move politely. Currency markets offered another clue. The dollar index hovered near 97, not dramatically weak, but not responding to strong employment data with the strength previous patterns would predict. That subtle divergence mattered. It suggested the market was pricing a future where the path of least resistance, despite current conditions, pointed toward easier monetary policy, not tighter. And if easier policy becomes the base case, metals get oxygen. Silver, being thinner and more volatile than gold, inhales that oxygen faster. The trading session closed with silver holding most of its gains. No dramatic reversal, no late-day collapse, just stubborn strength in the face of headlines that should have hurt it. That persistence, that refusal to conform, was the real story. Because markets that ignore bad news are markets that see something coming. The jobs headline told one story about the present. Silver's response revealed the market was already focused on a different chapter entirely, and that chapter was just beginning to unfold. The surface narrative seemed straightforward. Strong jobs, strong economy, strong dollar, weak metals. But experienced market observers know something most analysts overlook. Markets don't trade what happened yesterday. They trade what they believe will happen 6 months from now. And on February 12th, the gap between present conditions and future expectations became impossible to ignore. The dollar index sitting near 97 should have meant something. Strong employment data historically pushes the dollar higher, attracts foreign capital, strengthens America's currency position. Yet the dollar wasn't responding with conviction. It wasn't collapsing, but it wasn't surging either, just hovering, treading water, despite receiving news that should have propelled it upward. That hesitation, that lack of follow-through, was the market asking a question. Does strong employment today change what's coming tomorrow? The answer, apparently, was no, because beneath the headline employment numbers, a different architecture was taking shape. An architecture built not on monthly data releases, but on structural realities that don't fit neatly into Bureau of Labor Statistics reports. The United States faces a refinancing wave, over $7 trillion in debt maturities rolling over in the coming years. That's not speculation. That's arithmetic. And arithmetic doesn't care about unemployment rates. When that much debt needs refinancing, when interest costs consume growing portions of the federal budget, political pressure builds. Pressure for lower rates, pressure for accommodative policy, pressure for anything that makes the debt load more manageable. Presidents don't typically campaign on tight monetary policy. They campaign on growth, jobs, prosperity. And in February 2026, the rhetoric coming from Washington wasn't subtle. Public statements about wanting lower rates, about needing a more competitive dollar, about questioning whether the Federal Reserve's independence serves national interests. Some dismissed this as political theater. Others recognized it as the opening move in a larger game. Markets, being forward-looking mechanisms, began pricing the game, not the theater. Add another factor to the equation: Federal Reserve leadership transition scheduled for May 2026. When leadership changes, policy direction can shift. When policy direction might shift, markets position ahead of the shift, not after. So even with strong employment in February, even with equity markets celebrating, the bond market was whispering a different story. Rate expectations weren't firming, they were softening. Long-term yields weren't surging, they were contained. The curve wasn't steepening in ways that signaled genuine economic acceleration. It was flattening in ways that signal policy accommodation ahead. Currency markets heard the whisper. Bond markets heard the whisper. And precious metals, always sensitive to real rate expectations and currency debasement concerns, heard it loudest of all. Silver's surge wasn't defying logic. It was responding to a logic that headline watchers couldn't see. Geopolitical factors added another layer. Carrier groups repositioning in contested waters, regional tensions that refuse to de-escalate, the kind of background noise that creates persistent hedge demand. Gold traditionally captures safe haven flows during geopolitical stress, but silver has a unique characteristic. It functions as both a monetary hedge and an industrial commodity. When monetary concerns and industrial demand converge, silver doesn't just rise, it explodes. February 12th showed signs of that convergence beginning. The policy architecture wasn't collapsing, it was shifting. And shifts are often more important than collapses, because collapses get headlines, get emergency responses, get interventions. Shifts happen quietly, incrementally, until the new reality is already established. Consider what strong jobs data actually means in this context. It means the economy can withstand more stimulus without immediate inflation concerns. It means there's room for policy accommodation without triggering obvious overheating. It means political cover for easier monetary conditions, because employment looks healthy. So the very data that should suppress metals becomes the data that enables the policy response that supports metals. The paradox resolves when you stop thinking in headlines and start thinking in incentives. The incentive structure favors lower rates, weaker dollar bias, continued liquidity. Employment strength doesn't change those incentives. It validates them. Silver understood this before the analysts did. That's why it surged while commentators scratched their heads. The market wasn't confused. The commentators were. Real yields provide the final piece of context. When nominal rates stay low and inflation expectations remain elevated, real yields compress. Compressed real yields make non-yielding assets like precious metals more attractive on a relative basis. The jobs data didn't change the real yield trajectory. It just gave the market confirmation that policy wouldn't need to tighten aggressively. And that confirmation was bullish for metals. Silver's 4.5% move wasn't an accident. It wasn't speculation run wild. It was the market repricing based on policy architecture, not employment headlines. The jobs number told observers what happened last month. Silver's response told observers what's coming next year. And what's coming is a policy environment where metals have structural support, regardless of how many jobs get added in any given month. The architecture was already built. February 12th just revealed it. There's a truth about commodity markets that most people discover too late. Price on a screen and price in the real world are not always the same thing. And when that gap widens, when the difference between what futures contracts say and what physical dealers charge becomes impossible to ignore, something fundamental is breaking. Silver in February 2026 was showing signs of that break, not through dramatic headlines, not through exchange announcements, but through the quiet signals that professionals watch closely, signals that whisper before they scream. Start with the vaults. London, the heart of the global precious metals market, had been experiencing something unusual for months. Inventory drawdowns, not catastrophic, not sudden, but persistent. Metal leaving storage facilities, month after month, quarter after quarter. Each individual withdrawal looked manageable, but the pattern, the relentlessness of it, told a different story. Because inventory doesn't just vanish, it goes somewhere, either into industrial consumption, into investment demand, or into private storage where public tracking stops. And when inventory declines steadily while price remains elevated, it suggests demand is real, not speculative. Speculation shows up in futures positioning. Real demand shows up in metal physically changing hands. February's inventory data continued the trend. Not accelerating dramatically, but not reversing either, just grinding lower, week by week. The exchanges monitored for silver stocks told a similar story. Available inventory. The metal actually available for delivery against futures contracts wasn't growing despite higher prices. In normal markets, higher prices attract supply. Miners increase production. Recyclers ramp up activity. Old holdings get sold. The supply response is how markets balance. But silver wasn't responding normally. Mine production was increasing marginally, perhaps approaching 1 billion ounces annually. But that increase was incremental, not transformative. Because mining doesn't turn on instantly, new projects take years to develop, require massive capital, face permitting challenges, environmental reviews, infrastructure requirements. Even existing mines can't simply double output overnight. Ore grades are what they are. Processing capacity has limits. labor and equipment have constraints. So the supply response to higher silver prices, while real, was measured in single-digit percentage increases, not the surge that would flood the market and crash prices. Recycling, the scrap flow, faced its own limitations. Yes, higher prices incentivize people to sell old jewelry, industrial scrap, photographic material, but there's only so much silver sitting in drawers and attics. The easy scrap gets mobilized quickly when prices spike. What remains requires higher and higher prices to coax out. And even then, scrap flows are finite. You can't recycle what doesn't exist. Meanwhile, demand was doing something interesting. Not collapsing, but rotating. Industrial demand, the biggest component of silver consumption, was plateauing. Solar panel manufacturers, facing their own cost pressures, were engineering ways to use less silver per panel. Thrifting, optimization, substitution were possible. When silver hit $30 per ounce, engineers designed differently than when it's at $15. That's not bearish. That's rational business behavior. But here's what the headlines missed. Even as solar efficiency reduced silver intensity per unit, total solar deployment was still growing. More panels, but less silver per panel. The net result wasn't a collapse in industrial demand. It was stabilization around 650 million ounces. Still massive. Still the largest demand segment, just not accelerating the way it had in previous years. But while industrial demand stabilized, another segment was waking up. Physical investment demand, the actual people, institutions, funds, buying actual metal. Not futures contracts, not ETF shares, not mining stocks. Real silver, bars and coins, held in vaults or safe deposit boxes. Projections suggested this segment could jump 20% or more, potentially exceeding 200 million ounces. That's not noise. That's real hands reaching for real metal. And when investment demand surges, it has different characteristics than industrial demand. Industrial users buy consistently, predictably, based on production schedules. Investment buyers buy based on fear, opportunity, beliefs about currency and policy. They accumulate when they sense something coming. And in early 2026, something was clearly coming. Currency concerns, debt levels, geopolitical instability, doubts about the sustainability of equity valuations, all of it pushing certain investors toward tangible assets. Gold captured most of that attention historically. But silver, offering similar monetary properties at a fraction of gold's price, attracted a different type of buyer. The buyer who wanted exposure but couldn't afford 50 ounces of gold. The buyer who believed silver's volatility was feature, not bug. The buyer who understood the gold-silver ratio and saw value. When those buyers activate, when physical investment demand rises materially, it creates pressure that paper markets can't easily absorb because physical buyers actually take delivery. They remove metal from available supply. They don't roll futures contracts forward. They take possession. And possession, real physical possession, is what eventually matters. The premium structure told the story clearly. Spot price might say one thing, but dealers were charging another. Premiums over spot, the markup required to actually buy physical silver, were elevated, not at crisis levels, but persistently higher than historical norms. When premiums stay elevated despite rising prices, it signals tightness. It signals that the paper price and the street price are diverging. Delivery times provided confirmation. Certain products, certain sizes, certain form were showing longer lead times. Not because mints stopped working, but because demand exceeded immediate availability. Allocation became necessary. Rationing became common. And rationing, in commodity markets, is how tightness manifests before it becomes crisis. Now consider the mathematics. Total supply around 1 billion ounces annually. Total demand, industrial plus investment plus jewelry plus everything else, potentially exceeding that by tens of millions of ounces. A deficit, not enormous, but persistent. Deficits don't resolve themselves through hope. They resolve through higher prices, demand destruction, supply response, or inventory drawdown. And in February 2026, inventory was already drawing down. Supply response was limited by physical constraints. Demand destruction in industrial segments was happening slowly through efficiency gains, but investment demand was rising to offset it. That left price. Price as the balancing mechanism. Price as the signal that attracts more supply and discourages marginal demand. But price discovery in silver has always been complicated. The market trades in two worlds simultaneously. The paper world of futures and derivatives, where leverage magnifies every move, and the physical world of actual metal, where delivery and storage matter. Those two worlds usually align, but when they diverge, when paper says one thing and physical availability says another, stress builds. February 12th looked like stress building. Not breaking, not collapsing, just building. Silver surging despite headlines that should suppress it. Suggested the physical equation was becoming too tight to ignore. The market was pricing scarcity, not abundance, and scarcity, once established, doesn't resolve quickly. It takes time, higher prices, and significant behavioral changes. The jobs data couldn't change any of that. Employment numbers don't mine silver, don't recycle silver, don't alter physical supply and demand balances. They might influence investor sentiment, they might affect currency markets, but they don't change how much metal exists or how much is needed. February 12th revealed that physical reality was starting to matter more than macroeconomic headlines. And when physical reality asserts itself in commodity markets, the moves that follow are rarely gentle. Understanding what happened on February 12th matters less than understanding what it reveals about the months ahead. Because silver's defiance of traditional logic wasn't a one-day event. It was a signal that the rules governing market behavior are shifting. And when rules shift, strategies must shift with them. The first strategic principle is simple but often ignored. Markets move on positioning, not just fundamentals. When too many traders expect one outcome, when consensus builds around a specific narrative, the market has a tendency to punish that consensus. February 12th likely caught many participants positioned wrong, shorts expecting metals to weaken on strong jobs data, suddenly facing a violent move against their positions. Late sellers who dumped metal ahead of the employment report, watching prices surge without them. Algorithms programmed for traditional correlations, triggering buy signals when historical patterns broke. That forced repositioning creates its own momentum. Shorts don't cover slowly, they cover urgently. Chasers don't enter cautiously, they enter aggressively. And once that momentum starts, it feeds on itself until positions reset. Silver's volatility amplifies this effect. The market is thinner than gold, more prone to explosive moves, more sensitive to sudden shifts in sentiment. That thinness is both opportunity and danger. Opportunity for those positioned correctly before the move. Danger for those caught leaning the wrong way when momentum accelerates. The second strategic principle involves silver's dual identity. This isn't just a monetary metal like gold, it's also an industrial necessity, embedded in solar panels, electronics, electric vehicles, medical equipment, infrastructure. That dual nature creates unique dynamics. When monetary concerns dominate, silver acts like gold on steroids. When industrial demand surges, silver tightens from the physical side. When both pressures converge, as they appeared to be doing in February 2026, silver doesn't just rise, it erupts. Gold provides insurance against currency debasement, silver provides insurance, plus industrial leverage. That combination explains why silver can outperform gold dramatically during certain phases, even though gold remains the primary monetary metal. The third strategic principle requires distinguishing between noise and signal. Not every move matters equally. Not every headline changes the underlying structure. Professional operators focus on three primary indicators when evaluating precious metals positioning. First indicator, dollar index trajectory and rate expectations. If the dollar sustains strength and rate expectations firm, metals face headwinds regardless of other factors. If the dollar weakens and rate expectations soften, metals catch tailwinds. February 12th showed rate expectations softening despite strong employment data, a signal that policy architecture matters more than monthly data releases. Second indicator, the gold to silver ratio. When this ratio compresses, moving from high levels toward lower levels, it signals silver awakening from undervaluation. The ratio sitting near 60 to 1 in February 2026, down from levels above 100 to 1 in previous years, indicated silver was no longer sleeping. Further compression toward the 50s would signal acceleration. Expansion back toward the 70s would signal exhaustion. The ratio provides early warning in both directions. Third indicator, physical market signals. Premiums above spot price, delivery delays, inventory drawdowns, availability constraints. These don't show up in futures charts, but they reveal real-world tightness that paper markets eventually must acknowledge. When physical premiums expand persistently, when dealers struggle to source material, when vault inventories decline steadily, the paper price becomes increasingly disconnected from physical reality. That disconnection doesn't last forever. Eventually, one of two things happens. Either physical premiums collapse back to normal, indicating the tightness was temporary, or paper prices rise to meet physical reality, indicating the tightness was structural. February 2026 showed signs of the latter. Strategic operators must also understand volatility architecture. Bull markets in silver don't move in straight lines. They lunge forward, consolidate violently, shake out weak hands, then lunge again. A 4.5% surge can be followed by a 3% pullback the next week. That pullback doesn't invalidate the trend. It tests commitment. If silver consolidates above key levels after a surge, holding the mid-80s despite profit-taking pressure, that signals buyer confidence. If silver collapses back below support, giving up gains quickly, that signals the move was positioning-driven rather than structurally supported. The days immediately following February 12th would reveal which scenario was playing out, but the broader framework remained clear. Multiple supportive factors were aligning. Policy expectations tilting toward accommodation, physical markets showing persistent tightness, geopolitical risks maintaining hedge demand, and positioning potentially still skewed against metals despite recent strength. When multiple factors align, trends develop staying power. When only one factor drives, moves prove temporary. The strategic mistake most operators make is confusing prediction with preparation. Trying to predict the exact the precise pullback level, the specific date when trends reverse, is fortune telling, not strategy. Preparation means having clear frameworks, knowing which indicators to monitor, understanding what would invalidate the thesis, maintaining discipline when emotions run high. For long-term accumulators, the framework is simpler. If the structural case remains intact, debt pressures ongoing, policy accommodation likely, physical deficits persisting, then volatility becomes opportunity rather than threat. Pullbacks allow accumulation at better levels. Surges confirm the thesis is playing out. The key is avoiding emotional decision-making, not buying at peaks out of FOMO, not selling at troughs out of fear. For tactical traders, the framework requires more precision. Position sizing based on volatility, stops placed at technical levels, profit targets defined before entry. The 4.5% move on February 12th created opportunity for those positioned correctly, but without discipline, without clear risk parameters, volatility destroys capital as quickly as it creates it. The final strategic insight is perhaps most important. Strong surface conditions, record equity highs, positive employment data can coexist with structural fragility. The system can look healthy while requiring continuous monetary support to stay healthy. That's not a contradiction. That's the modern financial architecture. And metals price that architecture, not the monthly headlines. February 12th revealed that architecture clearly. Silver surged not despite good news, but because the good news changed nothing about the underlying policy trajectory. The market was already looking past present conditions, toward future accommodation, and those who understand that distinction position differently than those who only read headlines. The jobs data told one story, silver's response told another. Strategic operators know which story matters more.